Per usual, everything on this channel is for educational purposes only and is not intended as financial advice. It's Macro Monday. Let's take a look at the weekly ETF and other types of products. Crypto asset flows from James at CoinShares. And I'll first mention the caveat that we do have a large basis trade arbitrage going on where we have funds longing the spot side of things via ETFs and short via futures, capturing the funding or the premium there. So this isn't exactly the entire story of what's going on, but we will take it. It's $2 billion across all products globally in 1 week. Most of that, of course, coming from Bitcoin, most of that being the basis trade. We know that based on the CME futures open interest, which is not shown here, but just as long as people are aware of what's going on, because you might say to yourself, well, we had almost 2 billion in inflows in Bitcoin. Why isn't price moving? Why isn't price above 70K? Well, that's why. It's not exactly a directional bet to the tune of $2 billion. It is a net neutral trade that we're seeing coming in as an inflow. Nevertheless, we're seeing inflows across all products for the most part. ETH getting a large chunk of that. Short Bitcoin seeing outflows. Multi-asset products also seeing outflows. Bold reports. ETF inflows, 30-day cumulative. Again, this is going to be affected by the basis trade inflows. So is it as valuable? Knowing that, I mean, it looks, ignorance is bliss. So it's going to look better than it is. It's going to look better than it actually is until people start asking the question, hey, why isn't price moving, right? Look at how bullish this 30-day inflow is. And price is still at the same price it was 100 days ago, right? A few other people have picked up on this. BitMEX did a little tweet thread on this. And again, we see futures OI and ETF flows roughly mirroring each other. It's not one-to-one. Not everybody on the future side is taking this trade. Not all of the short OI is basis trade OI. But with the assumption that all of it is, you start to see how this breaks down, where we see large futures interest correspond with ETF flows. Now, the existence of the basis trade in and of itself generally shows you that there's a bullish environment for price and a bullish future price. Here's another thread on this for anyone looking for more data. But not everything is as it seems with the flows on their own. And another interesting ETF side note, Eric from Bloomberg reporting that a bunch of ETFs are getting liquidated at BlackRock, including a gold strategy ETF, an ESG ETF, and total, it's around 430 million that they're liquidating. So they do not mess around over there with with what they keep or toss and which products they offer. Meanwhile, Bitcoin Spotland, not much has changed. We're at 69.9, 69.5, something like that. There is still this TK C-clamp possibility, similar to March, where we are overbought insofar as we've been momentumless here, so we're going to get this TKC clamp where the fast moving average is looking at the previous 20 periods and the key June, the slow moving average is looking at the previous 60 periods. The midpoint is flat, right? There are some other charts today in Legacy Land that I'll look at that look more at risk of a mean reversion than this, but this is just telling you the mean reversion is there. Momentum really is not there. 72K, obviously still the line in the sand. Now, relative to halving, if we look at last halving was just after COVID, the COVID candle, and we had a series of very long 6-month, 8-month consolidation periods. And this was with trillions of dollars of stimulus. It took months for eventually the market to wake up into Q4. So it certainly is not out of the question where we have a series of bullish TK crisscrosses, breakouts, right? So look, you just got to be patient, right? I'm not discouraged by not breaking out of 72. These things take time. Before I go any further here, let me mention today's video sponsor, Kraken Pro. Kraken Pro is a complete overhaul of the Kraken trading experience with a one-stop shop for advanced and professional traders. Kraken Pro enables efficient trading execution across multiple markets with a UI that allows for unique optimization tailored to your trading style. You can check out Kraken Pro with the link in the description of this video. Not investment advice. Crypto trading involves risk of loss. Cryptocurrency services are provided to U.S. and U.S. territory customers by Payward Ventures, Inc., PVI, DBA, Kraken. Now on Kraken, I always check the volume first. And for the past few weeks, probably months, we've seen Bitcoin at the top of this. Today's one of the first days we're starting to see stablecoins and FX ahead of Bitcoin volume. And that just tells you how non-volatile and how flat we are. Everybody's sort of waiting for CPI and the rates decision on Wednesday. We had a ton of FX volatility that I'll get to in a second, probably aiding this volume spike on Tether USD and Tether Euro. But it's all here. Should that interest you in trading Euro USD, Euro GBP, all sorts of fun stuff on Kraken in FX land, USD Euro is basically DXY. So this does look fairly bullish, or it's starting to potentially look more bullish, and we'll look at DXY specifically, but definitely don't like seeing DXY break out above the cloud there. And there's always this possibility that this is some sort of pattern compound fulcrum, I think it was called, whatever. But the cloud being as bullish as it is potentially could mean problems in the near term for BTC if we get a massive surprise spike in DXY even further. And I'll talk about that more in a sec. But the schedule for this week, again, Wednesday, CPI, 8:30 a.m., FOMC, 2 p.m. with the press conference at 2:30. Then the rest of the week is the excitement fading from Jerome Powell's press conference. All the analysis. We have PPI, which isn't going to hold a candle to the importance of the Jerome Powell press conference. Looking at GDP, it is showing signs of weakness, bounced above 2%. The next reading is on the 18th. All this data, at this point, we are beyond reality for everybody. If you are a doomer, you're going to see doomer things. If you are a optimist, you're going to see bullish continuation. And that's just all there is to it. It's a giant Rorschach test, ink blot. Everyone's just seeing what they want to see. So it's hard to have really objectionable analysis when a doomer has a multi-month time horizon or a multi-year time horizon and says, the sky's falling. Be prepared for that. Whereas the optimist is looking at all of the indices at all-time highs and saying, what are you talking about, right? Certainly no imminent fears of recession based on GDP. We also had jobs print last week. And again, it was all about what you wanted to see in the data. We had a large discrepancy between the BLS number and the household survey. We had a large discrepancy between full-time and part-time work. As Jeff points out here, this tends to signal a weaker labor market when the gap between full and part-time work looks as though it does now, right? And there are all sorts of reasons for this. And you can think about, okay, why would somebody need multiple part-time jobs? Is this gig work? Is this cost of living increases, right? There's all sorts of reasons. Again, people are going to see whatever they want to see. Looking at Truflation came down quite a bit a week or two ago and has kind of stayed at that level. If we look at the May to June number, my fear, again, is this May print coming up here is going to be on the higher side, potentially, based if Truflation is correct, which it usually is directionally. The expected number is basically no change month over month. But again, if I'm looking for landmines here this week and I'm looking for reasons to be risk off, it's DXY strength on the back of geopolitical or global elections. Okay. It's CPI potentially coming in hotter than expected. And you can see next month, this current month, CPI should fall based on the Truflation numbers, but we're not quite there yet. We're living week to week, month to month here on these prints. Looking at the Fed nowcast for their May prediction, it's coming in at 3.36. So that is a drop month over month. And the current June forecast is 3.29. Still headed in the right direction, not where we want to be based on the Fed's 2% target. And a lot of people have jawboned about this for many months, many weeks, including hundreds, if not thousands, of articles about why the vibes are down versus the data. And it comes down to this. We have pulled forward a decade's worth of inflation. Cost of living is astronomical. CPI is not reality. People live and have lived through COVID over multiple years. We know what the numbers are. You can't really pull the wool over our eyes. And of course, the retort will be, well, wages are way up as well. And yes, that is true. Wages are up. Wages are not up equally for everyone. And that is where we get into this problem. But these numbers don't really ever come down. So they just keep going up, right? That's another part of the problem. So we can all celebrate inflation cooling off, and we can celebrate inflation expectations potentially cooling off, but the numbers aren't going down, and things aren't getting cheaper. That just isn't happening. But half the inflation fight is vibes anyway. Now we are seeing a decline in gas prices using this specific 6-month average. These aren't the AAA numbers. This is Gas Buddy, who tends to track these prices pretty well. And this certainly has a positive effect on inflation going down. So that's also good to see. But again, the doomers are going to say, well, we're draining the SPR. This is going to have XYZ effect into the election. That's what it's all about. Sure, right? Like, I'm not going to disagree. It is what it is, but that's where we're at, right? That's where we're at on the Rorschach test. So as far as a Fed meeting this week, 0% chance of cuts or hikes. Currently, as we sit, even in July, 0% chance of cuts or hikes. September would be a 50-50, and we'll have a lot more data by then. But I think most people currently are expecting Powell to come out and just say, more of the same. We're getting there. We're not there yet. We may see some cuts later in the year, potentially, right? Depending on how bad the jobs numbers actually get. Looking at yield spreads, this thick red line is the current yield curve. We're still heavily inverted. We've been inverted for a record amount of time now. The belly of the curve has been all over the place, wildly all over the place. The long end has been all over the place. The front end continues to come down ever so slightly, with 3, 4, 6 month rising ever so slightly. So in the very front of the curve, we're starting to uninvert just ever so slightly, right? As you go out on duration, you're getting paid for more duration. But obviously on the belly and the long end, it still doesn't really make any sense at all. One of these days, I'm going to show this chart, and you're going to see a line going from bottom left to upper right, and that's what the yield curve should look like, of course. And if we look at everything together, rates in the purple, yield curve in the white based on the 10-2, and then jobs in the yellow, what we tend to see historically over time, Fed is cutting as unemployment is rising, which is probably what we're going to see again. As unemployment is rising and the Fed is cutting, we see the yield curve uninverted ahead of that, which we have not seen yet. That's probably the expectation of cuts, the expectation of recessionary type behaviors, and then the actual recession hits. So we are still fairly far away from that. And again, the doomers are going to say, well, start protecting yourself today. The sky is falling tomorrow, right? And that's fine. There's a place for that. We can't go up forever. As they say, trees don't grow to the sky. Eventually, there will be an upper limit here. But I think we still have a little bit of wiggle room, a little bit. The 10-3 also very much inverted, which is the preferred recessionary indicator for the yield curve. And you can see just how far ahead this uninverts before the recession is actually declared. So we're not even uninverted on this yet, right? We got time in my book. Along the same vein, looking at the high yield bond, corporate bond ETF, HYG, this is heavily positively correlated with BTC. Generally, higher HYG would suggest higher risk appetite. So from a technical perspective, I think it's good that we're seeing this work its way through the weekly cloud, potentially signaling a bullish breakout into Q4. And it just reiterates again, patience. There's no imminent breakout here, right? We're just not seeing that. So as a trader, you really don't want to blow up before the big move. If you can just wait for your pitch, wait for your setup, wait for the breakout, whatever it is, versus getting chopped up continuously in this range that we're seeing on BTC. Looking at liquidity, this is reverse repo, and most of the liquidity has been drained. We've been talking about this for weeks now, but most of it's been drained, and we're kind of just sitting at 400 billion, slightly under 400 billion. We're not really getting a bonus liquidity effect from this anymore, which is another reason why, partially, that we're seeing a slowdown in the indices in Bitcoin. We're not getting juiced by some outside force here like we had been. And if we look at global liquidity in the green, that's come down slightly based on the TradingView metric. US liquidity basically just ranging and flat. And you can, of course, have some viewpoint on liquidity and say, look, I know liquidity is going to be rising in X weeks, X months, X years. Liquidity is going to be rising because of Biden, because of Trump, because of whoever's election, blah, 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 right? And if you think the opposite, then you take the other side of that trade. But I think it's hard to find somebody on the macro side who doesn't think liquidity is going to keep expanding in the next 4 years. Now, as we get into FX volatility, there was a stat that I talked about, I don't know, maybe 6 months ago, 3 months ago, talking about just the percentage of the planet that is having elections this year in 2024. 40% of the GDP, I think it's like 60% of the people. Okay, so 40% of the people based on Bloomberg numbers, 40 countries. So tons and tons of elections going on, even other elections beyond that. So not all these are going to end in the expected outcome. And because of the way DXY and the dollar relative pair is set up, most of it is dependent on what happens with the euro. We, of course, have other stuff in the DXY. But should the euro take a spill lower, DXY will take a move higher. That will put pressure on risk assets to a degree. So previously we've had this, we've honestly had lots of stuff here. We had that falling wedge. We had another sort of mini head and shoulders here, a larger head and shoulders, whatever. Now that's bounced, and it just echoes the range that we're seeing on Bitcoin, on the S&P to some degree. So either want this to be quiet, non-volatile, or declining, right? We do best when DXY is declining. This is the euro chart with the daily cloud. Slightly concerning here that this is now showing a potential head and shoulders again, another triple top type fractal. Really, this has also just been ranging for multiple months now. But just this week, we had a bunch of stuff over the past week in France, in Germany, in Belgium, a lot of political volatility. And even Travis acknowledged, like, look, maybe Bitcoin is going to outlast euro. You know, to be fair to Travis, he didn't say maybe. I tend to agree. At some point, something's got to give here. And what that's going to look like for the DXY, you know, what happens here, I assume the DXY goes much higher first, and then the euro gets removed from the index effectively, right? Like, let's say the euro explodes as a thought experiment. You know, what happens? Do people turn to BTC? Do people turn to the dollar? Maybe political upheaval is what the euro needed to turn itself around. We'll see. But it's obviously part of the reason why we've seen massive volatility in the DXY. We're seeing more right-wing politics winning in Europe, whereas in Mexico, we have the other side of the coin, and we have the dollar lifting off on that. We, of course, have UJ, which continues to lift higher, and BOJ interventions will put pressure higher on yields, which puts pressure downward on risk. So there's just a lot of landmines right now, right? And this is USD CNY, which is just continually being devalued as well. I remember when 7 was a big deal, and then from 7 to 6 was a big deal, and now we're at 7.25. And I don't really hear too many people talking about it, but that's helping the DXY get stronger, or the dollar get stronger. We had Indian elections where Modi did not get the expected majority. That caused a bunch of chaos in their stock market. And this USD INR chart just looks like continuous up only to me. So there's just a lot of reasons right now why the dollar is strengthening, in my opinion. And then we, of course, have the US elections coming up at the end of the year, and taking us back to November 2016, you can see the massive volatility on that day when Trump was elected. Throughout his term, we did see dollar devaluation. He has said, his advisors at least, want to devalue the dollar. So despite the initial bullish push for DXY, the dollar did end up falling throughout 2017 and 2018. So again, if there's anything that can put a wrench in bullishness for risk assets, it's a massively bullish dollar. Its yields much higher. It's the rest of the world's currencies exploding against the dollar. If you're denominated in the dollar, as Bitcoin is, that is also a relative value play. So if one end of the spectrum, if the USD is rising, Bitcoin will have a downward pressure there. Looking at the S&P, we are at all-time highs. Looks fine. It doesn't look exciting to me. It doesn't look like it's screaming a buy, but it's crazy the amount of bears I hear and see with prices at all-time highs. You know, it's like they were wrong all of 2023, all of 2024, and now they are back at it, right? They're back at it saying the sky is going to fall, blah, blah, blah. From a cloud perspective on the daily, there is a TKC clamp here, similar to July, August, September 2023, similar to March, April, May 2024. The first step is losing the Tenkin, which never really happened in 2024, at least in this rally, until the very end. So we're far from that. You know, we attempted to lose the Tenkin. We pulled up, but so far so good. Look, there's no issue here. There's nothing screaming at me other than that. There's no like massive rising wedge. There's no massive divergence. Yes, there are bear divergences on this on RSI, on volume. It doesn't look like a buy, but it doesn't look like a mega sell to me. This is ES mini futures continue to show a cup and handle on lower time frames, bullish TK cross. This is just some random time frame, the 8 hour. This is where the cup and handle would measure. And this looks like a recovery to me. This looks like something that tried to break down and couldn't. So in the moment, it certainly leans bullish. Here's QQQ. QQQ a little bit more volatile around the Tenkin in 2024. But again, you have the same sort of be careful up here type of mentality with the TK C-clamp starting to form. You can see how in early 2024, it pulled back and then went again, right? You can see a low time frame cup and handle there as well. And you're not really in trouble until you lose the Tenkin for consecutive days, and then you sort of mean revert to the Kijun. So you could get bearish here, but it's, again, we're at all-time highs. Like, yes, is it slightly overbought? Of course. Is it overbought based on fundamental metrics? Of course, but not exactly screaming a sell. IWM, a bit of a different story to me. This does not look bullish. It needs to prove that it's bullish first. This looks like a head and shoulders all day to me. So it's going to be very interesting to see what this Wednesday candle looks like for the IWM, depending on what JPOW has to say. My guess is by Wednesday, we'll know pretty conclusively whether or not this thing's going to break through the daily cloud or not, but it does not look bullish. DJI has ranged pretty heavily. This is where most of the commodities show up. And we're basically flat since the beginning of the year. Not really much to speak on other than that. NVIDIA had its split today and looks fine. Looks like it's consolidating again. Anything between 112 to 120 is probably fine. You can see how far away it is from the Tenkin, how far away it is from the Kijun. This probably needs lots of time up here to consolidate if we are going to see bullish continuation. Very similar to March to June. It took months for a reconsolidation, but any mean reversion would probably see support at 100, and then you're going to have people calling for gap filling down to 94 or something, but chart looks fine up here. It's not screaming one thing or another. SMCI, maybe a little different story. It had a pretty massive head and shoulders consolidation earlier this year. That broke down. Now it has another kind of pseudo angry head and shoulders consolidation here. It's already bearish on the cloud. This trade, unlike NVIDIA, looks like it certainly came and went. It's up a ton this year already until this is back above the cloud. I don't really see a long trade here. Support for many reasons would be somewhere in the 520s, 550, 560, based on 50% retrace of the previous rally, based on the head and shoulders earlier in the year, that target, and based on the current, whatever you want to call this, target, right? It's all down there in like the mid 500s. So once again, it needs to prove that it's bullish first, right? If anything, the DXY chart is concerning from a risk on perspective because it is trying to cancel out, it is trying to negate this mess of whatever this is, right? Is it really a head and shoulders? Probably, sure, right? It's got a series of higher highs in a descending fashion in a neckline, right? So to see us make a higher high here is definitely concerning for risk assets. Apple had their conference today based on the candle. It wasn't what the market was looking for. Now, this is probably the largest TKC clamp you're going to see on any chart in the market right now. This thing reversed massively when they announced the record buyback, finding resistance at the 200-ish all-time high. And it just says you need time. Now, if the S&P looked like this, yes, that would look like a mean reversion risk, just as this does. But the S&P does not look like this. This is pretty extreme. It just went straight up. So it probably needs time to prove itself, consolidating underneath all-time highs before it makes another attempt, potentially. But I don't really see a trade here. Haven't seen a trade on Apple in quite some time. Microsoft looks okay. Maybe some sort of multi-headed head and shoulders thing eventually, but it's way too early and way too messy to really say anything other than it's back above the cloud with a bullish TK cross, right? The trend following system is saying this is a long, even though I don't feel great about it. I don't feel great about Amazon either, but Amazon kind of saying the same thing. It's back above the cloud, bullish TK cross. I think this is at or near an all-time high as well. I feel much better coming out of something like September, October, November, where we're breaking out of the cloud after attempting to break down. But this just looks like ranging to me. Meta, the same thing, right? The cloud is telling you bullish TK cross, price above cloud. It's telling me specifically, it's talking to me, saying this is a long. I can't get myself to do it. I just can't. I don't know who's excited about buying anything up here. And maybe no one's excited about buying anything up here, and it doesn't matter because all the passive money is buying up here, right? But the trend following system certainly likes it. Google looks fine, right? There's some sort of parabolic hastening to this rate of change here. But again, is anybody excited about buying this up here? I don't think so. But the chart looks fine, right? The trend looks fine. Netflix, same thing. It looks fine. I'm just not excited about touching that. Now, the one chart that does have a setup, a trade, is Tesla. Unfortunately for my calls, Tesla's down today, but that's okay. We'll see what it looks like after the annual meeting and the Elon pay package vote or whatever. I'm not expecting this to be bullish. I'm not expecting it to break out. I'm expecting this to be highly volatile, but it's a real test of the chart pattern system. It's a setup, so we're taking the trade, but in any event, this looks much different than the rest of the Mag 7. Obviously, it's been down on the year for quite some time. And trend-wise, it's definitely not bullish or bullish continuation. Looking at IGV, which is the software ETF, again, we looked at that last week. It bounced from the 77 head and shoulders neckline level, still below the daily cloud. This has to prove that it's bullish, and it really hasn't done that yet. Hasn't proven that it's going to break down either, and it's probably just continued chop for the foreseeable future until it tries to make another low below 77. KRE, the regional banking ETF, does not look bullish to me. That may be good news for us on the Bitcoin side of things. We tend to be inverted relative to the KRE ever since SVB and that debacle. It is below the daily cloud here, working on a bearish TK cross, working on some sort of descending triangle. Maybe it tries to retest this diag from earlier in the year. Definitely a failed W double bottom. And it just looks heavy. Looks very heavy. Just cannot catch a bid whatsoever. So maybe we have some more failed banks on the horizon here, the longer we keep rates where they are. Another chart that I just thought I'd highlight, Costco. It is also at all-time highs. It isn't screaming a sell, but it does have this TKC clamp behavior to it, where much like a plane just sort of going straight up. I mean, here's a great example in March, right? Just the plane just keeps flying straight up. Eventually it stalls and the engine shuts off and you mean revert, right? So it just looks like we need a little time on most things here across the board. On the Bitcoin side of things, WGMI minor ETF. This is above the daily cloud, bullish TK cross, bullish cloud. It has been ranging for months at this point. I don't really think there's any pattern here per se. You can probably squeeze this into something, but the longer it can hold above the cloud, the longer it has the chance to have bullish continuation, right? At the end of the day, it needs to be above 20 and sort of break away from all of these other horizontal resistance levels it's got at 20. Here's the breakdown in case you're curious of what's in this thing. They did bump the cores holding recently, and I certainly like the IREN and Wolf positioning there. And it is interesting. Post-halving, it's recovered quite nicely. So just something else to watch in the periphery. And for MSTR, again, I'm not excited about it, but it is a bullish TK recross with price above cloud. This is screaming, based on the trend system, a long entry. I just don't know if I can do it. I don't know if I can pull the trigger here. This is the NAV premium chart. It's still sitting at 2x NAV, and maybe it doesn't matter. Maybe I just need to left curve this and bite the bullet. This would be the cup and handle target, basically 2,500 to 3K. I think this has no problem breaking out if Bitcoin is above 72. You know, that's the next step for anything Bitcoin related would be new all-time highs for BTC should, in my opinion, obviously mean anything BTC adjacent should see a decent push higher. So it probably makes more sense to just wait for that than pulling the trigger early. But this is signaling it's go time today, right? This is exactly what you want to see on the cloud. And then if you want the poor man's MSTR, SMLR, Scientific, they are also buying BTC. They've bounced quite a bit from the lows there. And maybe if you squint your eyes, you can say, well, this is a inverted head and shoulders or something with a neckline at around 50. And it looks a lot like a lot of the other charts pre and post COVID, where they had this insane run up and have just been bled dry over the past couple of years. And as we get closer into Q4, maybe liquidity comes back, maybe rates come down, maybe we see a better environment for things like this to do well. But again, if BTC breaks out, this is a known company buying BTC with their treasury. So you'd expect this chart to continue to do well. So that's all I have for this one. Watch out for Wednesday. It's going to be a doozy for volatility is my guess. Probably best to dial back the leverage and just be an observer, a spectator, see how it all shakes out. Like, dislike, comment, share, subscribe, and happy trading.